Okay, this is being recorded. I mentioned this at the beginning of every single webinar. If you are newer to options trading or newer to the way that I'm teaching, if you've never heard me teach before, watch this again relatively soon after. For one, it will make some of these nuances stick into your long-term memory. You're going to remember this longer. And two, you're going to have questions and stuff like that arising throughout this webinar. And you might miss something while you're waiting to ask your question or waiting for me to give you an answer. And that's one thing I want to note here is if you guys do have a question, bring it up immediately because I want to make sure everybody has clear a concept before we move on to the next section. I'm not going to make you wait to the end in order to be clear of what we're doing because we'll probably need that information going forward. So I want to make sure you guys are good to go before we move on. Ted, how are you doing? Best wishes to you and the family as well. And happy, healthy, and prosperous new year to everyone out there, including you, Ted. Thank you for the kind words. Appreciate that. All right. Poor man's covered put. This is great in this type of scenario, right, that we're in. You know, we've seen a bear market start to come into fruition. This is going to be an opportunity to really take advantage of the poor man's covered put. And you guys really should know this strategy because a lot of our portfolios get very long, right? We go out and we buy stocks and that makes our portfolio value go up only when the market really goes up. When the market goes down, it's kind of like there's an old saying, a rising tide lifts all ships, right? That's the same idea with the stock market. If the stock market's going up, it lifts just about all stocks. Vice versa, on the way down, you know, Apple was getting crushed today and it was bringing down the broader market as well. So, you know, that tide going out sinks ships in a sense. And when our portfolio is very long, then we need to add some of these negative deltas to our portfolio so that when the market does correct or has a bearish turn to it, we can profit from that and we're not beholden to just a bullish market. So, you know, this is a strategy I think everyone across the board could implement just at about any time and, you know, feel confident they're doing the right thing, whether it is a portfolio adjustment on deltas being, I'm just way too long deltas and I need to add some negative deltas to my portfolio or just adding some market directional bias to that portfolio, being to the downside in this case. Let me get a couple of things out of the way real quick. My name is Eric Wilkinson. I've been trading for over 25 years. I actually started trading in college and then after graduating with a finance degree, moved to Chicago to work on the floor of the Board of Trade in the pits. 25 years later, I'm still trading, but I'm trading online just like the rest of us. And in that time, I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all these products in basically all market conditions. And finally, we got to go over this disclaimer real quick. It says any opinions, news, research, or analysis or other information contained in this webinar or material provided by Pro Trader Strategies and or associated companies or employees is provided as general commentary. Okay. I can't give you guys investment advice. It's not right because I don't know what's in your portfolios and I don't know what your risk parameters are. What I can do is teach you how to do these strategies. You need to determine whether or not it is appropriate for you and your portfolio. And please remember that past performance of any trading system or methodology is not necessarily indicative of future results. You can also follow me on Twitter at Wolfman's blog or follow our parent company at Pro Trader Strat. I'm becoming a little bit more active on Twitter. I usually only tweeted out what trades I was doing in the afternoon for those people that were missing the daily market commentary, that trade in the daily market commentary, because I usually talk about that in the morning. If I do something late in the afternoon, I want to make sure you guys see that coming, so I put that out on Twitter as well. And Pro Trader Strat has all kinds of market wisdom and other offers and things like of that nature that you would be able to take advantage of. All right, so we're going to be talking about how to build this poor man's covered put. In it, what this is really, you guys, is like a short on a stock, and then you're buying or you're short a stock, and then you're getting this long put covered by a short put. So the long put is the short in the stock, in a sense, because that's what we're trying to create, a short stock position. And then we're going to sell a put, which caps off our profitability, at least for that first month. But it also reduces some of our risk as well, because we have risk in that back month we're buying. We want to mitigate it by selling this front month put. And I'll go into detail as to why we're going through those steps in detail here in a minute. But I want to get you guys the idea that it would be like you're selling a stock short and then you sell a put again. It's completely opposite of a covered call, all right? A stock that would be long and then you sell a call against it. It does limit your profitability, but it reduces your risk at the same time. All right, so a couple of things to note about the poor man's covered put. It is a diagonal spread. The reason why it's a diagonal spread is because we're using two separate monthly expirations and separate strikes. That's why it's not a calendar spread. You guys, we just learned about calendar spreads not too long ago. Calendar spreads have the same strike. So that's what makes this a little bit different. Another thing is it's covered puts on leaps. You know, the leaps are kind of like that synthetic short stock in a sense. So it's very similar to that. It's even less risky than covered puts on the leaps, really. I don't like to go out to those long anticipated securities. So I go a little bit closer. Usually people talk about a year to a year and a half out with these on these long-term anticipated securities. I usually go 6 months to a year. The reason why is I want to be able to pay off that theta decay rather quickly. So in order to do that, we need to go a little bit closer with that option we're buying. You can do this, and some people do teach it or suggest going out a year and a half to 2 years on these leaps. The problem is you have to really stay active with this strategy. The other problem is it's very hard to determine even a week or two out if the market is going to be bearish for a particular underlying, let alone 2 years. Okay, so I don't want to be in this that long. I'm usually in trades for short durations of time, which is why I want to go to the shorter duration put instead of using these leaps. But online, they're going to tell you to use the leaps. I would suggest that you don't do it. So why we use these options instead of shorting or borrowing the stock? One, it's reduced risk. You know, there's the cost of doing this, for one, is less. With the poor man's covered put, the difference between shorting the stock and buying this put that we're going to be supplementing it for, the put, we only have risk to the upside so far, and then we no longer have any more risk. If you shorted this stock, you have risk continuously as this market rallies. We have limited it by using options, and I'll show you how we do that also a little bit later on. All right, reduce capital requirements. If you short a stock, you're going to have to put up the entire margin for that, all right? So if, or a full boat margin. So if it's $100 stock and you do 100 contracts, it's going to be $10,000. With the strategy we're using, it's going to be reduced dramatically. Almost, it's only going to be about $2,500 for a $100 stock. So reduced capital requirements in order to implement this strategy is a huge bonus when we're trading this. Think about it. You can have a much smaller portfolio and have the same type of profitability as somebody that was going out there and shorting stock. As a matter of fact, I would argue that you would be more profitable and higher probabilities with this one because there's a lot of ancillary costs that go with shorting a stock than just going out and buying it as well. There's borrowing costs and everything else. I mentioned it creates a more diversified portfolio of securities. If you consistently did this instead of stocks, then you would be able to create more opportunities, which creates higher probabilities of success. If you're just throwing the dart at the dartboard, it's a lot more difficult to nail the number than than if you had several opportunities. For instance, if you had several darts to throw at the dartboard or just one to hit that bullseye, your probabilities get better with the more amounts of opportunities, right? Okay, so higher probability of success. I mentioned this. It has a higher probability of success also because of that embedded put as well. And return on capital, it goes back to reduced capital requirements. If you don't have to put up as much capital, but you have dollar for dollar the same profitability, then your return on capital is much higher because I've used less capital to capture the same profitability. Okay. This will create the same profitability as if you were doing this, with the shorting of stocks. Right. And one of the other thing is the borrowing cost. You don't have to use, you don't have borrowing costs associated with the options as you do with the short stock. When you go out there and borrow that stock, you have to pay for holding that stock. All right. The disadvantage of this is we're going to have to stay active in option cycles with earnings, because even though I'm shorting that or getting that duration where we're not out a year and a half to 2 years, where you would have maybe 6 and sometimes 8 different earnings events going on in there, we're only going to have to deal with maybe 1 or 2 of those earnings events. So we are going to still have to stay active in the earnings, but we aren't going to have to stay active for very long. And this disadvantage really goes in regards to this strategy. If you shorted a stock, you're probably going to have to deal with the earning cycles as well. All right. The long put will eventually expire. If you did the short stock, you can hold on to that for a very long time. You are going to have to pay those maintenance fees, but you can hold it for a lot longer of time, whereas this put will eventually expire. Forced assignment. Yes, you may have forced assignment on the short call, or sorry, on the short put. That's the covering of our long duration long put. This is going to be the short duration short put. We could have forced assignment on that. If the market slams down, goes through our short put, somebody could force assignment on that. Well, we have the long put where we can force assignment on that. We have the right, but not the obligation to assign it. Okay. Whereas when we're shorting that put, we have the obligation. So we can always offset that forced assignment though. We do have to be aware of that. I would be out of this strategy well before I'm going to ever have to worry about this forced assignment. Okay. I'm going to be covering that trade as soon as I get tested basically on that short put. So I'm not going to have to worry about the assignment. My rules are going to have you exit this strategy before that happens, and it will likely come into fruition if the market goes down there and touches our short put. That's when we're going to look to cover it. All right. So some of the rules of thumb, these are like my essentials to success. If you watch some of the other webinars, it doesn't really correlate so greatly with the poor man's covered put on just those essentials to success, because there's a couple of extra ones. So I'm trying to change it on this one for rules of thumb. But you know we have to have a solid underlying, all right? These are going to be along those environment. Usually you hear me do the EUDS, which is the environment, the underlying, the duration, and the strike prices. Okay. So those are the major ones that I normally look at. We're still going to be following those rules. It's, in the rules of thumb here. So a solid underlying, usually what I'm talking about there is for a stock that we're picking, when we go into the option montage, we need to make sure that these options are, you know, close in proximity to one another for trading. Okay. The bid ask is what we're really looking at. And I will show you that during the day sessions, these rules will be much more apparent than they are right now in the off session, because people are canceling orders and the markets get wide. But during day sessions, my rule of thumb on a stock over $100 is move the decimal place 3 ticks to the left. And that's how wide our bid ask should be. So in this case, we'll round it up to 16. the bid to the ask should be 16 on these options with the closest to expiration. That we call it the spot month. This is probably not the spot month. Once you get inside of 20 some days, people start rolling out to the further duration, 45, 35 days to expiration. And that becomes the spot month where the most time and volume is being traded. All right. So, we'll usually work with this, 15 days to expiration. You start getting inside of 10, it could get a little bit wider. But having said that, we look for move the decimal place 3 ticks to the left, should be 16 cents wide to the bid ask on these options, the monthlies that are closest to expiration. Out here, it doesn't look like it's working out, but I can assure you I double checked right before the close, and these were all working as well. They will be in line. Any stock that's under $100, what we do is it's 10 cents wide. Should be inside of 10 cents wide to the bid ask on these options that are closest to expiration. All right. So we're going to be looking here and in the puts for that rule of thumb. So 10 cents wide on a stock under $100, and just move the decimal place 3 ticks to the left on any stock over $100. And that's your ballpark. That's where you should be starting. Right now, with high volatility in the markets, extremely high volatility we're seeing, you can see that expand a little bit, gets a little bit wider, because think about it, the more volatility that's out there, the more risk that's perceived, and the people making the markets aren't going to be willing to make really tight markets for you when the markets are juking all around. For instance, going unchanged before that, being down 500 to going unchanged in the Dow to being down 500 again in a day session. Somebody has a lot of hedge risk, is what we used to call it. Is if I'm doing the options, I have to go offset that somewhere else. But in that meantime, there's a lot of risk because the market is swinging all over the place. Therefore, I need to make my markets wider in order to cover that risk that I'm going to have in laying off some of these strategies. So the markets will get a little wider when the markets get volatile. Okay. So that is a rule of thumb. Make sure it's a solid underlying. And that would be for a green light. If you guys know of a stock out there that you like to trade a lot, and it doesn't quite fit the rule, and say, for instance, it's consistently a, $60, $70 stock, and the bid to the ask is consistently about 15 cents wide. If you're used to trading that stock and you are used to that market, then just say that that's a yellow light. And if you get too many yellow lights on all my rules, then there's probably a better strategy out there that you can take into account. Also, with this, we're selling something up here in this front month where we have the tight bid ask, because that's where the most time and volume has been spent. But then we're going to be going out here into the further duration contracts where there's a little less liquidity and going to have even wider markets. So know that if the markets are really wide up here for a $50 stock, let's say they were 30 cents wide, out here in the further duration that we're going to be buying, that market is going to be at least twice as wide. So we're going to have to give up a lot of edge to get in and get out if you're using these wide markets. And that's going to eat into your profitability, all right? And your probabilities of success. Because if you have to give up a lot of edge to get in, you're going to have to give up a lot of edge to get out. And that's going to eat into your return, okay? So, and especially if you're a newer trader, stick to this rule pretty wholeheartedly. I mean, 25 years of trading, and I'm still sticking to this rule, all right? I don't like to go outside of those, that rule of thumb on the tight bid ask. And then 6 months to a year out, right? This is what I was talking about. A lot of people will talk about using a year and a half to 2 years out for that long put on those leaps, those long-term anticipated securities. That, to me, there's just too much theta in there, too much time. I'm never going to be in this stock for 2 years riding this thing out. I'm usually looking at a correction or something like that and looking for like maybe a month or two of a market moving in that direction. That's about as far as I ever look out in time. Any further out, I think it just gets way too murky. It's murky enough a couple of weeks out, let alone over a year or so. So I like to stick it to 6 months to a year out. So we're looking at around that, 150 days about for our 90 to 150 days for our option that we'll be buying. All right. We don't want to pay a lot of money for that extrinsic value. All right. As a matter of fact, we're going to be trying to pay off all of that extrinsic value. And what is extrinsic value and intrinsic value? Well, options that are in the money. Okay. So these options that get into the gray area are in the money. They have intrinsic value and extrinsic value. Intrinsic value is intrinsically what this strike is worth. All right. So the 55 put in this case, what is that 55 put worth? Well, it's worth $2.80 or 78 cents, right? Because $2.78 added into this makes it 55. That's what this is worth, $2.85. All right. But we're paying $4.65. That's because there's extrinsic value, and we want to pay off that extrinsic value because that extrinsic value is basically theta decay. It's what is going to decay over time. It's going to decay, in this case, 4 cents a day out of this option, right? That is what we want to mitigate. We want to buy this option for what it's worth, and that's at $2.78. So we're going to have to build this strategy out so that we can pay off all of that extrinsic value in the first trade if we can. Sometimes we might need to roll out through the weeklies, but for the most part, we're going to be able to pay off all of that extrinsic value in the first time we put this trade on. And then therefore we have this option on for its intrinsic value, what it's worth. Okay. And when you go out here to those, 2-year puts or whatever, you're going to have so much extrinsic value. You're going to have to do it, probably roll that short put 3 or 4 months in a row in order to pay off all that extrinsic value. So therefore, you're having less risk with this strategy being closer. If we can pay off all of that stuff that goes away with time, then we've lowered our risk on this strategy. And this is the way to set it up as far as I'm concerned. You go with this 6 months, 6 to 9 months really for that one we're going to be buying. All right. So don't pay a lot of money for that extrinsic value. And I'll show you how to work that out so we don't pay anything, hopefully, for it. And we want to use lower volatility stocks. Now, when I say this, I'm not talking about implied volatility. We're going to be talking a lot about implied volatility. And implied volatility has to do with these particular stocks in and of themselves. What I'm talking about with lower volatile stocks means, like not necessarily the Teslas, although it can be done with this. You're just going to have some swings in your P&L as this market moves because, like Tesla moves quite a bit on any given day. All right. Apple lately has been moving quite a bit on any given day. Those tech stocks carry a higher volatility than, say, a utility stock. So what I'm saying is you want to go do this with the kind of ho-hum stocks that don't make a lot of jerky movements. We want to get something that is just slowly trudging down these steps. Okay. We want to slowly just move down. The reason why you get a real quick snap, like we've been seeing lately in the markets, volatility kind of affects those front months a little bit more than the back months. Usually volatility affects the back months more than the front months. But in this environment where we get these really snappy moves back and forth, we start seeing that volatility move to the front. And that's what we're seeing right now. That works out better actually for this strategy because think about it. If we're buying an option with low volatility, we're selling an option with higher volatility. That means we're selling high volatility and buying lower volatility. That's quote unquote the quintessential rules, Wolfman's rules to trading options. So we're getting the best of both worlds right now with this strategy. We're going to be able to exploit both of my favorite things to do. Expanding volatility and contracting volatility all at the same time. But use stocks that aren't really big movers on any given day if you can. All right, and sell the near-term out-of-the-money strike. Now, when we're selling this near-term out-of-the-money strike, that near-term, we're trying to capture that theta decay. And I'm usually looking at around that 36-ish delta to sell out of the money, all right? And that's going to be the one that gives us the best bang for our buck. And the one that we're selling in the near-term is going to experience this type of theta decay, all right? Now, when we're talking about theta decay, all things being equal, this is the at the monies. We're going to be using slightly out of the money. So this curve could be slightly different, but you get the idea of what I'm trying to convey here is the one we're selling is going to lose value quicker than the one we're buying out here 90 plus days out. This curve continues to flatten out further in time. So we're going to be buying slow theta decay, and we're going to be selling this upfront one that decays rather quickly, all right? That being the case, we get to pay off that extrinsic value quicker, right? This is still going to hold on to some of that theta that we've already paid off, right? All right, make sure that there's not a big difference in that Vega between the 2 months. Vega is just volatility, all right? And I have a couple of different rules for this. And it usually, in most environments, is determined by increasing volatility as we go out the curve. Right now, so for instance, this January to this February, you can see it increases. All right, my rule of thumb here is a green light is an increase of less than 2% increase here, all right? That increase of less than 2% would work with this rule. That's a green light. 3 to 5% increase, that's a yellow light. Anything over that is a total red light. Just walk away from it, because when it increases that dramatically to like that 5% difference, think about it. When you're buying this one, you're buying high volatility, and you're selling this one, you're selling lower volatility. We don't really want to do that. Most cases, we're going to have to do that, like the way this is doing, but we don't want it to get too out of whack. All right. This is a normal increase that we're going to be good with. Something like this from 46 to 52, that would be a bad scenario. That would be a red light. We wouldn't want to do that. All right. Right now, though, we don't have to worry about a lot of these because it's actually higher in this near expiration than in the further expiration. All right. So we aren't going to have to necessarily worry about that as much, because we could even see on these Feb, June that we are going down. So we're going to probably not be looking at the January, but we're going to be looking at these June out here. And you can see the June volatility is 43. It's lower than the one we're selling. So we don't have to worry about that rule. It's only on the increase. All right. If it's a decrease, we don't have to worry about it. So we only have to worry about this increasing too much. We don't want to be buying high volatility and selling low volatility. All right. If at all possible. All right. So max profit on this is the width of the strikes minus the debit paid. So if we use a $10 wide strategy, you know, and we pay $7.50, our max profit would be $2.50. My rule of thumb with this for the width of the strikes, 75% paying 75% the width of the strikes is a green light, all right, or less. 75% or less is a green light. So in that example I gave you, $10 wide strikes paying $7.50, we are paying 75% the width of the strikes. Therefore, it's a green light, all right? If it's 75 to 85% the width of the strikes, being the most we would want to ever pay is $8.50 on a $10 wide, right? That's the most you would ever want to pay. Anything over that, skip it. There's other strategies out there that I teach that will be more appropriate for your directional assumption than this strategy. All right. Some people, if you let that short call expire or short put expire worthless, then, you know, your profitability, max profit, is when that underlying goes to zero, or some may consider that unlimited, but really it can only go to zero, right? All right. Our max loss on any debit paying strategy is the debit we paid. That's the beauty of doing a debit spread, is we know what our risk is getting into this strategy. Our risk is whatever we paid for it. One thing to note is I won't ever teach this strategy backwards, where we're buying the front and selling that further duration. Somebody's asking about that. Do I ever do this backwards? I don't even teach it, because I don't want that long duration slow theta decay on the one I'm selling, right? And the fast theta decay on the one I'm buying. I want my assets that I'm buying to hold on to value, and the one that I've gotten rid of to just go to zero, right? The apple you hold, you want that to stick around for a couple of weeks. The one that you sold, you want that one to have a worm in it. All right. So our break even is that long put strike minus the debit paid. And I'll go over this in detail, how we come up with it, but it's pretty easy. It's the long put strike minus the debit paid. And the beauty in this, and this is one of the benefits of this strategy that you wouldn't be able to otherwise achieve, is sometimes if you go out there and short the stock, you're basically doing it where the market is. You're going to be selling that stock short at the market. With this strategy, when we build it out, we can actually be selling this underlying higher than where the current market is, meaning we're selling it above the market. How often do you get to do that with stocks? You don't. So with this stock, we're going to be able to try and sell it higher than where we are currently. All right. So without further ado, I'll pull up the trading platform again, and we'll start looking at different strategies or different stocks with this strategy to see if it works out. So think of some stocks that we're looking for that are bearish or looking to turn bearish. Las Vegas Sands, you know, something in this mid to lower range of volatility, right around the 40 to 50s is pretty good for this one. Even lower is fine. I wouldn't go any higher than the 50s and maybe even the 60s. If you get up into the 70s, for sure, let's look at something else. You'd be wanting to look at like a short call spread or something like that, I think. So stay away from those really high implied volatility stocks. We want something mid to lower range on this one. All right. Apple, of course, is a big bear right now. We can take a look at it. Let's take a look at Apple. It does have that higher implied volatility. So when we're talking about implied volatility percent, what I talk about here is you have to figure out where implied volatility for this particular stock is in relation to where it's been in the past, because this implied volatility has a tendency for this underlying. It's not every underlying, you know, Apple being at 43 near the high end of its implied volatility range may be pretty low for something like Tesla. Okay. So every stock's implied volatility is correlated to it. So, you know, Facebook's going to have its own volatility where it kind of normally hangs around. You can see with Apple, it's usually the mid range is usually right around this, I would have to say 33. Okay. So that would be about mid range. So with implied volatility percent, when it gets too high, it wants to revert back down to the mean. When it gets too low, it wants to come back up to the mean. All right. It's just a product of the market. Just like the markets, when they get too high, they want to come back down. When they get too low, they want to come back up. All right. So they all have their ebbs and flows the same as this does. But what we need to figure out is where this implied volatility is in relation to where it's been in the past. And the way to do that is we take a fraction in the numerator. We take the sum of the current implied volatility minus the low, and you divide that by the high minus the low. Okay. So in this case, we've got 43 as the current, and we subtract in the numerator 13. So in the numerator, our sum is 30. And in the denominator, we take the high, which is 50, minus the low, which is 13. So we have 37 in the denominator. So 30 divided by 37 is going to be somewhere in the 90, very close to the 90 percentile. So that's a little bit high for this strategy. As a matter of fact, we can go up here and look, it's 80. So my ballpark math was a little bit off, but that's how you do that math for implied volatility percent. If you're on TD Ameritrade, they give it to you in several places, and this is one of them. IV percent is 81. So that's a little bit high for Apple. Everything else being equal, it would follow the rules of the volatility Feb to the April. It actually decreases quite dramatically. So in that regard, because it's such a dramatic drop, you might be able to look at it because you're getting such a discount on it. But I think that I would rather just stay in this for the short term and sell some calls or something to the bearish side, and which would have a higher probability of success. You know, so I talk about higher probability of success strategies. You know, when you get up into this really high implied volatility, you know, there's better strategies out there suited for that type of scenario. So I'd probably rather just do a different strategy in and around this one than the poor man's covered put. All right. Somebody else threw out Disney. Amaro threw out Disney here. So let's take a look at the chart. You also don't, in the option we're selling, the option strike we're selling, we don't want that earnings event in that one we're selling. You know, we do have to stay active in it throughout earnings. And that's usually the stock that we're buying. That's the one we want to have the earnings in, not the one we're selling. And in this case, if we sold the February, we're going to be getting that option that we're selling in an environment where we would expect volatility to expand. You can see in the past, volatility expands going into those earnings. And if we're short this put and volatility expands on us, that's going to hurt our strategy. So definitely stay away from having an earnings event or a binary event for that underlying in the one we're selling. And this one has that happening. When I say a binary event is just a known event that is going to affect a specific underlying. So the FOMC is a binary event for the treasuries, okay? Earnings is a binary event for that specific underlying. So we want to stay away from that. So I'm going to move on from Disney with that one. Somebody else threw out, what was it? FDA plays. Are you talking about with the, you're not talking Food and Drug Administration, right? Oh, biotech. Yeah. Biotech, you know, yeah, biotech, you would have to worry about the trial results, or like you said, the FDA coming out and saying, you know, whether or not they're going to accept it. But the trials are another one that you would have to worry about for biotech as well. And what was I looking for here? So somebody else threw out Adobe. Okay, so Adobe, it's got medium to slightly higher volatility. We wouldn't have to worry about the options that we're selling for this because you can see the earnings is way out almost in March. So we don't have to worry about that. So let's take a look at Adobe here. Adobe on the chart, it's looking like it's in a bearish pattern. So I'm good with that. Implied volatility percent is in the 60s. We're good with that. The other rule we need to check, right, is it's a $200 stock. Move the decimal 3 ticks to the left. Make sure it's 20 cents wide or tighter. It's really wide right now, but Adobe usually has pretty tight markets in there. I'm going to say that it works because I trade Adobe a lot and it has tight markets. We're going to be looking at this April contract, maybe even the June, but I'm going to look at the April first because I'd like to go closer to expiration if I can. I don't want to be in this strategy for the rest of my life. I just want to be in it for this bearish move I think that Adobe is having, right? So we're going to be looking at around that 70, 80 delta, or 75 to 85 delta. Usually around that 80 delta is kind of the sweet spot. So just think of it as the 80 delta or the closest to it. That makes you comfortable. And we're going to be buying this one. Now, we buy that option. And then remember I was going through that whole math with the intrinsic and extrinsic value. What's this worth and all of that stuff? Well, here's a real quick trick that we used to use on the floor. And it's not exact. It's not going to give you the exact number. All right. But, if I'm a nickel or two off, and I don't have to go through all that math I went through before to figure out what this value is. I mean, it's actually pretty easy. You can do the math in your head. It's like $29 and 30 cents is what this is actually worth. So one thing to note, just look over here. This usually will give you a very close representation of the extrinsic value, because out of the money options are all extrinsic value. Right? There's no intrinsic value to this options because it's out of the money. There's no value to it. It doesn't hold its own value because it's out of the money. It's all theta decay. So the corresponding call will tell you what the in the money put, or at least very close to it, has an extrinsic value that we need to pay off. So if I'm looking to buy this 245 put, I just look over here and say, I need to pay off $2.50 and I should be good to go. So, so I go in closer. I did do those. Oh, I did the wrong month. I'm sorry, you guys. I need to go out to the April to buy. So I look for that 80 some odd delta. So it's the 260s, sorry. Because I want to go out over 100 days for sure. So again, same thing though, go straight over here. This is the extrinsic value of the 260 puts. So I need to pay off $4.50 up here. So I go to these options. I look for the puts that are $4.50. It's usually going to land somewhere in that 20 to 30 delta. Usually it's further. Puts have a tendency to get pumped up a little bit more than the call, the poor man's covered call. So you can get a little bit wider, and it makes the strategy a little bit easier to implement. When we were doing the poor man's covered call, we had a couple of them where it didn't really work out on my paying less than 75% the width of the strikes. Well, with the puts, a lot of times it is a pretty for sure thing. All right. But having said that, I said I needed to do that $4.50, I think, off the top of my head. So that would be that one, right? So let me just double check my math. I did the 260s. The 260s go straight across. Yeah, $4.50 is what I needed to sell. So I sold $4.50 here. That works that out. Now, how do we do our break even? We take our one we bought, the put we bought, which was $260, and we subtract what we paid, $43. Subtract that $43. Our break even is $217. That's what I was talking about. If we set this up right now, we are selling Adobe 50 cents above the ask. I'm scalping that guy for 50 cents right now. Right? If you just went out and sold the stock, you'd be getting it above the market. So, or you'd be getting it at the market. You'd probably be selling it at $215.70, let's say. Well, I'm selling it at $217. Where would you rather sell it? $1.50 lower or $1.50 higher? Right? So building this strategy out, that's one of the perks of that, is your break even is above where we're currently trading. You're already into profitability. All right? And we can take a look at the Analyze tab real quick. Let's take a look at that on this chart, or on this tab, I should say, with this little graph. And this is the risk reward. You can see to the downside, we have limited risk. All right. Or sorry, to the upside, we have limited risk. To the downside, we have limited risk. This is where we sold that put. That limits our risk completely there. On the downside, that's where we can't make any more money. Or I should say, we've limited our profitability, and here we've limited our risk. Sorry, I've been said that backwards a couple of times. We've limited our risk to the upside. Now, with this put, if we shorted the stock, right, this curve would not happen. It would just continually go at this trajectory higher. But we've limited it. We can't lose any more money above $260 a share. All right. When you're doing these options, remember I said you bought this. You have the right but not the obligation to put this stock to somebody, right? Well, having said that, we also don't have any more risk to the upside. It's got a synthetic stop in it, in a sense, where we don't have any more risk in there, or, a synthetic long put around the short stock, a collar, if you will. This is more akin to a collar in a stock where you're basically selling a put to finance the other put on a short stock in this case. This has a synthetic one in there, so we're limiting our risk to the upside without having to worry about it because it's got that already in there. So Adobe works out quite nicely. Fits all those rules. We've gone, the implied volatility went pretty much straight across, maybe a slight, and actually it's completely straight across. So the volatility we're buying is the same as we're selling. We don't have to worry about that. It increased less than 2%, right? Another one somebody threw out there was FedEx, I believe. So FedEx is another one we can look at. Let's just check the charts to make sure. They just had earnings, so they're not going to have earnings in this contract we're buying. So I don't have to worry about that. We look at the front month here to make sure it's a solid underlying. It's $157 stocks, 3 ticks to the left, 16 cents wide is where we should be on this. You can see it's 50 cents wide. I can assure you it usually is tighter than that and will fit this rule of right around 15 cents, 16 cents, even in the markets we're having right now. This is my rule of thumb for this on the bid to ask. On an over $100 stock, let's say it's a $200 stock, and you're like, all right, I moved it 3 ticks to the left, 20 cents. Well, Wolfman, it's trading, it's 27 cents wide. Well, in these types of markets, yeah, you can stretch that a little bit, right? Because all of those markets are experiencing that for all those reasons I told you about, the market makers making wider markets and all of those reasons, because they have that, hedge risk, right? So they could be a little bit wider right now. Normal market conditions, when, all of last year, basically, I would have stuck to this rule quite strictly. This one, now you can probably stretch it for a nickel or so, especially on the stocks that are over $100. All right, but make sure you're checking this rule during open operations, all right, because they're going to be fitting that rule more so than afterwards, because afterwards we all cancel our orders, right? All right, so we're going from 35 volatility to the April, which is a 35.8. So it only increases by less than 2 percentage points. We're good. We're good to go with this one. So we start looking at around that 80-ish delta. So I'm going to go with the 180s. And I've got to look over here and see, all right, we got to pay off about 335 in extrinsic value. Come down here. So I can't get that 335. I'd have to go really close to pay it off altogether. So I might even go a little bit higher on this one. I'll go out to the 185s, look to pay off $2.50. And that allows me to go a little bit further out there. We've gotten a wider, we're going to have to pay a little bit more, but we've got a wider spread. Okay, so we got to check our break even to make sure, because we really don't want to be selling this at 155, right? Where it's below where the market is currently trading. We only really like it when we're selling it above or at the market, to be quite honest. And if you're selling it below the market, like if the math comes out to 155, that means you haven't paid off all of the extrinsic value of the option that you bought. All right. That's a quick note. All right. Well, all of a sudden I'm selling it below the market. Well, I must not have paid off all of the theta decay or all the extrinsic value. All right. So let's figure out our break even here. So we've got the 185 strike is the one we're buying, and we subtract $27. So subtract $27. Oops. 185. Subtract the where's my subtract the what is it, $27? So 158. We're able to sell this still, even though I rounded it above where the market's at. That means we paid off all the extrinsic value. Our break even's above. We've got all those things going for us. All the other rules are fitting. And the next thing we have to figure out, is this less than 75% the width of the strike? So we have $40 wide and paying $27. So we paid $27 and divide that by the $40 wide strikes, and we've got 67%. That fits the rule. That means we could implement this into our portfolio. If it's, like I said, if, it was say this was, and I've seen this, you guys, seriously, something very serious to note that I may not have mentioned in the last one is you can set this strategy up. Go online and just read what they tell you to do with this strategy and setting it up. There are examples out there where you could be paying more right now, paying $40.01, all right, for a strategy. Not the way that I set it up, or according to my rules is not going to happen. But according to some of these other rules out there, I could be setting it up the way that they said and paying $40.01 on a $40 wide spread. That means I can't make money until at least after the first month of everything going right. Okay? So stay away from that. Stick to my rules on this with the paying less than 75% the width of the spread. All right? Because you can lock in a loss. That paying $40.01, you've locked in a loss for at least the first option expiration that you got involved in, the one that you got short. In this case, it would have been the February. We don't want to do that. We want to stay away from that. Okay? And then as soon as this market goes down and hits my 145s, that's where I'm getting out, all right? I've beaten the probabilities on this strategy. I'm going to be at my profit target, which is on this one, I'm going to try and take about 50% of my max profit. And in this case, we paid $27 on a $47 wide strategy. $13 is my potential profit, right? Because if I take 27 and subtract it from 40, that means our max profit is $13. I did that negative, sorry. I should have done 40 minus 27. But the 40 minus 27, the width of the strikes minus the debit paid, right, is our max profit. So the width of the strikes in this case is $40 wide minus the debit paid, which is $27. Our max profit is $13. So I'm looking to only take 50% of that, because the only way to achieve all of that is really to ride this into the sunset and have that full, really to have it nailed right on the number for the most part. But, and that go through the entire month for all of that theta decay and everything else being equal. It's got to be right there at 145 for the most part, or slightly below it, in order for us to get that max profit at expiration. I don't want to deal with that. It's the cost of offsetting all of these. If I get assigned and I have to assign and all of that, those costs of all those commissions and everything else is going to eat into my profitability. And I might end up at that 50% of max profit after subtracting away all those fees and everything else. Aside from the anguish you're going to be like, watching this day and night, especially going into expiration. Forget about all that. The market comes down, hits 145. I'm going to be at 50% of my max profit as soon as that happens. Believe me, it will happen. And that's where we're going to be looking to cover it. 50% of my max profit. Now, people also ask me, well, what do you do on the other side, on the flip side? Well, I have a tendency to, if I pay a debit, I am looking to ride that out into the sunset. But if, for instance, I was going to do it around this strategy, I'd probably look at this and say, if it looked like it was going to, you know, start rallying, I had on the 185s, I think it was, right? Which would be above this Fibonacci. Well, I would probably say if it came up and settled above this Fibonacci, that's where I'd be out too. Okay. So I don't have a problem with you adding in some of these other ancillary things. You know, if I set it up, you know, for a bullish trade and it broke below the low here, I might say that's my out, right? If I was bullish and it broke that low, I'd probably say I'm out. Same, for instance, on this. If I had a bearish trade and broke above, you know, one of these highs, then I'd be out. For instance, this one, maybe if it looked like it was going to go to cover that gap, you know, it started trading and settled above this high. Now I believe it's going to cover that gap and go to the Fibonacci extension here. Then that's where I would get out. So there's a lot of different ways to, you know, and I talk about my rules on some of these get outs a lot more in the daily market commentaries because, you know, I trade around this market profile. I see somebody is asking about the market profile. And I have a webinar on teaching how to trade around this market profile. I'm not going to go into all that right now. But I use Fibonacci and market profile on my market assumptions and where I think the market's going to go, support, resistances, that stuff as well. And if I break one of those support and resistances, I'm out, you know. And I talk about that in the daily market commentaries when I'm getting into a strategy. I say, hey, you know, I'm looking for 50% of my max profit to get out. If it goes against me to this level, that's where I'm looking to get out, okay? And I tell you all those different nuances and go into the charting and all that a little bit more in those daily market commentaries. So take advantage of that more so for those little nuances that I use to get in and out sometimes that aren't a rule of thumb for every single strategy. You know, my rule of thumb for a debit strategy is ride it into the sunset. You know what your risk is. You don't have anything to worry about. You got into it. You knew what you paid for it. Go with it. All right. The probabilities are in your favor. So write it. But if you have something that you use like support and resistances that work for you and you're looking to implement options to trade around that strategy, then yes, definitely implement that. But I would stick to my exit on the profitability side. 50% of max profits where I'm looking to get out. You've beaten the probabilities, even if the support was right below where your out is. I'm pretty solid on getting out of my strategies when I achieve my profit target. Okay. That's the way to stay mechanical, you guys. If you don't write this stuff down and you don't keep track of yourself, you aren't going to have, for one, the data to go back and look at to see whether or not what you're doing is working. But two, if you write it down, you're more likely to stay mechanical. You're sticking with it. If you don't write it down and you kind of have it in your head, yeah, you'll have a tendency to, I'll wait a day. I'll wait a little bit longer. And usually that's the kiss of death. Believe me, I can't tell you how many times I've seen people beat the probabilities, like in this strategy. If you beat the probabilities by going down to our strike that we had, which I can't remember it offhand, 145 strike, you know, we've beaten the probabilities. You know, it's less than a 50% chance that that's ever going to happen. So if I had something go in my favor with a less than 50% probability of success, wouldn't you take that? Right? So stick with that rule. I'm telling you, I've figured out the probabilities. I've increased the probabilities of success by doing that. All right. You only have a 24% chance of a 24% chance of this put being in the money at expiration anyway. That's low chances. 75% chance it's not going to be. I just told you, you beat the probabilities on even being tested. The you know, it's got a 50% chance of being tested. That's pretty good, right? So as soon as you've won that probability, get out. All right. Does that make sense for everybody? You guys have any other questions? All right. So I really, in all of my webinars and in the daily market commentaries, you guys, I try and take the fear out of this. I know that media and, you know, even the policy makers for the lawmakers for trading, they don't understand the beauty and the flexibility of options. And that's to our detriment because they set us up for failure in that regard. Because with options, you have a much higher probability of success than you do any other way of trading. All right. And in that, yes, sometimes we do have to take more risk, but if your probabilities of success are dramatically better, then it's worth taking on that risk. All right. That quote unquote risk. I look at it as if the probabilities of success, if I have an 85% probability of success, am I really taking on risk? You know, all that risk that they're talking about that I shouldn't be doing? That doesn't make any sense. If I told you that you could win 85% of the time, you're going to probably do it quite often. All right. So I try and take that mystique away. I try and wipe away the fear and break it down into the nuances so that you guys can learn it and remember it better for longer periods of time. Okay. I have all kinds of like little, trader hacks that I've learned over the course of my 25 years of trading on the floor that I teach you guys, you know, kind of just like that intrinsic, extrinsic value thing, right? That makes it easy. Most people are going to go through the math. I mean, I tell you, just look right over there. That makes it so easy. And I do that with all of these. This is how to trade options like the Wolfman. The link is in the chat window. We've been going back and forth in this questions over here. Over there in the chat window is a hot link to this so you can take advantage of it for $36. You can't beat it. I talk about the odds of measuring or the how to measure delta, all of the different things that it teaches you. Gamma, trading using that market profile. Jerry was asking about the market profile and what that was on the side. I show how to trade that. History of options, protecting your portfolio against rising interest rates. I know you guys see this in some of my other offers as well. It's because I think it is so important that everybody should be watching this webinar. I'm not kidding. This is one of the most important things to be looking at right now because we're in a rising interest rate environment. Portfolios that don't get watched very often are our bond portfolios. And as interest rates go up, that bond portfolio goes down in value. And I show you how to offset some of those risks with that. So for $36, you know, I teach all of these things, how to play the probability when the probabilities have gone against us, how we stay mechanical to increase those probabilities even further in our favor, which is the only way to create alpha. I know mainstream media talks about alpha all the time. The only way to really create alpha is with options. And I teach that I break it down into its nuances so it's easy to understand, all right? So you guys, when you're using the right tools in the right situation, you guys are going to be more productive state of mind and be able to put on more strategies, which creates more opportunities. And when you have all those opportunities, you are going to be more confident and be able to do it further and further. You know, somebody else was asking me, you know, how am I so confident with, you know, the market the other day when we started seeing that bottom happen and we got a bit of a bounce. I don't know if it's a dead cat bounce yet or not, but I saw that and just decided to start putting on some strategies. Well, somebody asked me, how did I know that was the bottom or whatever? I don't know it's the bottom. All I know is that when the opportunity arises, we had the environment just like I like it. I needed to put some strategies on. Sometimes, you know, I wouldn't say force yourself to trade, but sometimes you need to go in on a day of trading and you look at your screen and you're like, today I'm going to put on 3 trades. Maybe it's 3 different strategies and you have your market assumption you go through, I'm going to put on 3 trades, or you don't even have to have a market assumption, to be quite honest. Just start going through the stocks and looking for it. And first, get yourself to put on 3 trades. Because once you get into the trade, you're going to trade in and around it. You know, that was something they used to do on the floor also, is like, you know, if they saw you weren't trading and you were getting analysis paralysis, well, the market's going to go up or it could go down because I'm between the, all of a sudden we've got this golden cross, but it's up against the Fibonacci support. And, you know, so it looks like it should go bearish, but now I think it's going to go higher. And now I can't do anything because I'm both bearish and bullish. You know, all of those things create analysis paralysis. And, you know, we have this thing where we kind of talk ourselves into one thing, and then all of a sudden, okay, well, what's the downside of it? And I talk myself out of it right away. Don't do that. Go with your gut. Go through these things. That looks like, I think, a bullish thing. All right, what's the environment in and around it? Wolfman's rules would say implement this strategy and put it on. Small. I'm not saying go big or go home. I don't ever say that. Keep it small. I would rather have you put on, you know, tons of different strategies, you know, 10 or more different underlying small than going 1 or 2 big ones. That is not appropriate. All right. We want multiple opportunities because we want the probabilities to be in our favor. If you just pick one, you know, that could be the one that the probabilities go against you, but you have multiple probabilities, you are going to be more successful. KD, yes, we will be sending out a recording of this. Please watch it again, especially if you guys are newer to options. Wolfman, great video. Your 20 videos are demonstrating the scans and tables using Thinkorswim. I do have some where I have some scans on them using Thinkorswim. Yes, I have played around with a couple of those. They're a little bit older, but yes, I do have some of those. I usually use my watch list as my scan area because my trading is determined by implied volatility percent, all my strategies. So, you know, they don't really have a good filter for high implied volatility percent with all my rules and stuff. So usually when I find a stock that fits the rule of the tight bid ask, that is what makes it over into my watch list. Okay, so those stocks that are over in my watch list will have that rule of thumb between the tight bid ask. Under $100, less than 10 cents wide, over $100, move the decimal 3 ticks to the left. Those will fit that rule. That makes it into my watch list. Then I have the implied volatility percent, you know, in descending order, so that when I need to add you know, high probability strategies, then I just look at the high implied volatility. And when I want to look at buying premium, then I look at those really low implied volatility. But I go through all of that in these videos as well. Some of that stuff will be in these on the trading. So take advantage of this. I can't emphasize it enough for $36. You know, if you were to make a mistake on a poor man's covered call by going online and figuring out what they said, it'd be worth it, right? And, you know, locking in a loss on that $40 wide spread and you paid $40.01 for it, you know, avoiding that problem is worth the $36. All right. So I want to thank you guys all. In later webinars, we're going to be drilling down on different option components, when and where I find those trades, especially in the daily market commentaries. You guys, I talk about every single trade I do, when I put them on, when I take them off, whether they're a winner or a loser, all the way through earnings. So, you know, you guys can keep track of me. Also, here's a link to my special offer right here. If you're on tape delay, you're going to have to pause it. Like I said, live, you guys can take advantage of it in the chat window over there. I want to thank you guys all for watching. If you have any questions, you can contact us at 310-598-6677 or email us at trading@protraderstrategies.com. All right. I want to thank you guys all for all your feedback. See all the kind words. Happy New Year to all you guys. I hope everybody has a very prosperous new year. And portfolios up, you know, 25 to 50% next year again. So hopefully we can stick to it. Stay mechanical. Keep your eyes out on Twitter and watch those daily market commentaries. All right. That's all I got for you. If you can't take that, take it easy. Thank you, Marvin. Appreciate it. Take care, Andrew. Thanks, Chris. Take care, you guys.